Harnessing the potential of the scalping strategy in Nifty and Banknifty can change the landscape of trading in a significant manner. This strategy, if mastered correctly, could open up new horizons for traders by giving them the power to leverage even the most minute fluctuations in the market. The essence of the scalping strategy in Nifty and Banknifty trading lies in its innate capacity to capitalize on minor price changes. It presents itself as a unique, innovative path to amplify profit margins and could potentially reshape your trading portfolio altogether. However, the question then arises, how does one effectively employ this strategy to their benefit? The key to unlocking the power of this strategy is in the strategic utilization and understanding various market indicators, which can guide you in making informed trading decisions. The answer indeed lies in understanding and using indicators. Indicators are the tools that traders use to forecast potential price movements by studying past patterns. These instruments of trading, which serve as navigational aids in the tumultuous seas of stock trading, are essentially our guides to predicting future price movements. To be successful in the fast-paced world of scalping in Nifty and Banknifty, these tools become all the more significant. There are multiple indicators, each with its unique utility and application. But in the context of scalping, a few stand out. These most effective and commonly used ones are moving averages, Bollinger bands, and the relative strength index, often abbreviated as RSI. These are not just mere indicators, but powerful tools that can help traders decide their course of action. However, deploying these tools without understanding would be a futile exercise. To implement this strategy, these indicators must be understood and used in a systematic manner. Firstly, consider the moving averages, a crucial tool in your trading arsenal. This indicator, as the name suggests, is calculated by taking of a certain number of past prices. It's like creating a moving picture of the market's past behavior, presenting it in an easy-to-understand form. The simplicity of this concept belies its immense utility in the world of trading and finance. It can serve as an incredibly helpful aid to identify market trends, patterns, and potential turning points in price action. Let's delve a little deeper. When we say a certain number of past prices, it can mean closing prices of the last 20, 50, or even 200 trading days, depending on the trader's preferences and strategy. This number is flexible and can be adjusted according to individual trading goals and market contexts. Now let's talk about its practical application. When the current price of a trading instrument, say Nifty or Banknifty, is above the moving average, this typically indicates an upward trend. In the parlance of trading, this can often be interpreted as a signal to buy, as optimism reigns and prices are expected to continue rising. This is where the utility of moving averages truly shines. Conversely, when the price is found to be below the moving average, it signifies a downward trend and is an indicator that prices may be on a path of decline. This is often taken as a sign that it may be the time to sell, to avoid potential losses from falling prices. Next is the Bollinger Bands indicator. This tool is an incredibly significant one in the world of technical analysis. It's developed by John Bollinger, a veteran in market analysis. It consists of a middle band, which is essentially a moving average. This moving average is not static and changes based on the price fluctuations in the market. Surrounding this middle band are two outer bands, which are standard deviations away from the center. These bands effectively serve as boundaries of price movements. They're not rigid walls, but dynamic lines that expand and contract based on market volatility. When the price of a security, say Nifty or Banknifty, touches the upper band, it can be a signal that the market is in an overbought condition. Overbought refers to a situation where there is a high level of buying activity, potentially driving the price up to unsustainably high levels. In such a scenario, a reversal might not be too far off, indicating that the investors may start selling off their holdings. Similarly, when the price touches the lower band, it can mean that the market is oversold. Oversold is a condition where intense selling activity has driven the price down to very low levels. In this case, a rise in price driven by investors buying into the market could be on the horizon. Finally, the Relative Strength Index, commonly known as RSI, is another indispensable indicator for scalping. In the multifaceted world of trading, the RSI stands as a fundamental tool used by many traders for its ability to gauge the speed and changes in price movements. It is an oscillator that measures the magnitude of recent price changes to determine overbought or oversold conditions in a market. When the value of RSI exceeds 70, it signifies the market, be it Nifty or Banknifty, might be in an overbought condition. This is a term used when prices are considered to be at a level too high and possibly poised for a corrective downward price move. It implies that the market is overpriced and a decline in price level might be imminent. On the contrary, when the RSI falls below a value of 30, it sends a signal that the market might be in an oversold condition. This suggests that the prices are at a level considered too low and potentially ready for a bounce. It strongly indicates a possible market recovery, and a price rise could be anticipated. When the RSI is below 30, it suggests that the market may be oversold, and a price rise could be expected. In summary, the scalping strategy in Nifty and Banknifty requires a detailed understanding of technical indicators such as moving averages, Bollinger bands, and the relative strength index. The foundation of this strategy is deeply rooted in interpreting the signals given by these indicators and leveraging them to make informed trading decisions. It's crucial to bear in mind that the real strength of this strategy is in your ability to act swiftly and decisively on the signals these indicators deliver. Yes, comprehending and mastering this method may seem a bit intimidating initially. However, with consistent practice and steadfast persistence, you can transform this strategy into a valuable weapon in your trading toolkit. The power of the scalping strategy lies in its potential to provide swift returns within a short span of time. Thus, it's not just about understanding the technical indicators, but also about developing a keen eye for spotting trends and reacting to them instantly. So why wait? Dive into the world of scalping and discover its potential today.